Hi everyone. Now this particular session would be in English, completely in English, but please don't worry. If you don't understand English, I'll mix a bit of Hindi also. मैं थोड़ा बहुत हिंदी भी कह दूंगा, although it would be very simple English. Okay. And we are going to discuss about something called ETF because a lot of my students had actually asked me. I had received a lot of requests to cover ETF. तो सबसे पहले let's understand what exactly is this ETF and why there is so much of hype. So ETF is just like a mutual fund. It isn't exactly a mutual fund. It's just like a mutual fund wherein you can get benefit of both equity as well as mutual fund. Now, how is that possible? Try to understand that ETFs can be traded in the market hours. So from 9:15 to 3:30, you can either buy or you can sell your existing ETFs, which is not possible when you are buying a mutual fund or even an index fund, because mutual fund or an index fund is going to take price during the closing of the day. So let's take an example. If market falls in the first half, you might buy an ETF, but let's say market falls in the first half and and by the second half it's again up, and if you have applied for an index fund, you will get it at a higher price. So that's the first thing which comes into ETF. I'll give you pros and cons, and by the end of this session you will be in a better position to devise your own strategy with respect to ETF. Now, why so much of buzz is around ETF? Why people are preferring? Now there is a debate between active and passive fund. I'll tell you about that. But before that, let's talk from the Indian perspective. In India, the ETFs are available on three broader categories. One is on the commodity front, that is on gold. The next one is debt, and the next one is equity. These are the broad categories. And I personally prefer more on a mix of gold as well as some equity based ETFs. In terms of equity based ETF, we always need to look upon the liquidity aspect. Kitna volume hai, how much volume is out there. When I talk about liquidity and volume, in Indian context, the highest volumes are in Nifty Bs, then Bank Bs, then Junior Bs. These are the three which have the highest amount of liquidity, which is again followed by some other this thing. For example, there is Infra Bs, there is PSU Bs, but unfortunately they still don't have so much of liquidity. So should we really buy them? You can, but I personally don't recommend to go heavy over there, because that could have more of tracking error as well as liquidity. What is that? Don't worry, I'll tell you. Next, you'll be surprised to know that when I'm talking about the global front, close to 8,000 mutual funds, yes, you heard it right, close to 8,000 mutual funds and 4,000 fund managers have actually invested globally into ETFs only. So you can obviously understand that the global markets have already embraced and they have understood the power of ETFs. The interesting part is the largest mutual fund now, which is there in the world, itself is dealing in ETFs. It's 100% ETF based mutual fund. So now you can realize that's important. Although Mr. John Bogle, who came up with the concept of passive investing and index funds, he had been preaching this for very long, but it was only till after 90s when the technology came into picture and financial reports were readily available for everyone that people realized that yes, this guy made sense. He wasn't just bluffing when he said that active funds on longer run fail to outperform and they cannot beat passive funds. So this guy had been completely preaching that. So this is exactly how the US and the other developed nations started accepting ETFs as their hardcore investing. In India, even government has recently shown, in fact, government and pension funds do have exposure. I guess pension funds in India have 15% exposure, and government has been doing is its divestment process. Almost 50,000 crore, if I am not wrong, has been raised via ETFs itself. So you can understand that even government has been supporting this ETF structure. The best part is the taxability is just like equity. So like in equity, short term 15%, and long term is 10%. Just like that, ETFs have been traded. A few people ask what happens to the dividends. We can't see it. It gets adjusted into the price. All the splits and bonuses are also getting adjusted, and you get equivalent amount of shares. So you need not to worry about that why I'm not getting dividend. The prices of course get adjusted. The another beauty is, which people don't realize, when you are investing into stocks or trading into stocks, there is a certain amount of STT which you need to pay, which is higher these days. On the contrary, when you are dealing with ETFs, it's almost negligible. So you get the benefit of trading Nifty Bs and Bank Bs without paying that hefty STT. That's another thing. The most important reason why I personally recommend a lot of people to have exposure in passive funds like ETF and index fund is because when you actually try to pick up stock, it's like picking up a needle in a haystack. But when you are actually trying to pick up an ETF, it's more like you already have a consolidated list of 50 stocks out there and you are actually going to buy. The beauty is you can actually buy entire 50 stocks with just one unit also. So by just paying 200 rupees or 150 rupees also, you can have certain amount of ownership, which is not possible in mutual funds. They have certain limits like 500 or 1000, and even in blue chip funds 1000, 2000. Another beauty is that you don't have to wait for a lock-in period. So today, let's say you invested into ETF, tomorrow due to emergency you need that fund back. You're not going to lose around, of course, if there is the prices have dipped, you're going to lose on that amount, but you are not going to pay extra amount. One reason why people prefer ETF is because of the expense ratio. What is this expense ratio? So whenever you are trying to buy a mutual fund, of course, to manage that mutual fund, the manager is going to have workers, the manager is going to pay salaries, the manager is going to pay the telephone bills, etc. So for that very purpose, they charge you some expense. So when you actually go through mutual funds, the expense ratio goes around 1 to 2 or 2.5%. Okay, because that's the choice. But in ETF, it's like 0.1, 0.15%. So it's negligible. But then, is it wise to invest into all the ETFs? Well, no. In ETFs, as I mentioned before, you have to consider a few things. First, expense ratio, you have to look which is low. Second, liquidity. As I mentioned, infra Bs, that is dealing with infrastructure companies of ETF, it hardly has a lot of liquidity and volume. So the difference between buyer and seller is too huge. So for you to go over there, it could be a little risky. Even though you believe that yes, real estates and infrastructure could be the future, it could be risky. But if you believe that India as a nation is going to grow, it's going to prosper, it is having a bright future, I would insist you to invest into Nifty Bs. As simple as that. If you feel banking sector is going to outperform, place your bets on banking sector. If you feel that some mid-scale companies or emerging companies can actually outperform into the market, you go with junior Bs. The best suggestion would be mix all these three along with gold Bs, so you can have good 4 ETFs around there in your portfolio. Now there are 2 concepts over here which I would talk about. First, the efficient market theory. What does this mean? It has been said that all the markets, not just equity markets, all the businesses, all the markets at certain point of time, they become efficient. What does this mean? See, inefficiency is, for example, when JP Morgan, I'm talking about the guy, I'm not talking about the bank, the guy who started JP Morgan, or Andrew Carnegie, or maybe Dhirubhai Ambani, or Mr. Birla, all these people when they started, or the, JRD Tata and all those people. So when they started, they probably had monopoly. So they exploited the inefficiency in the market and they got the advantage. But as and when the world progresses, India as a nation progresses, we can see clear competition, cutthroat competition amongst businessmen, and then a balance comes over there. And this is something which is also happening into equity markets. If you have seen in the last 15 years, the number of fund managers have increased, the number of PMS managers have increased, the AIFs have increased, hedge funds have increased, institutions has increased, and because of which efficiency is coming. And because of the same thing, it becomes very difficult for an individual entity to outperform. And that's why you can see a lot of differences. Because see, in equity markets, if you have to outperform with specific stock picking, First, you need to have great skills. Second, good knowledge. Third, you need to be upgraded, updated. And fourth, you should be really exposed